Well, welcome everyone to our first webinar of 2023. We are excited to get started again for another year. I'm Sandy Vandenberg. I'm Director of Plan Giving in the Torrance Memorial Foundation office, and we are happy to bring you these seminars. I do miss seeing you all in person, and I do hope that at some point this year we will be able to start that again and move back to our Saturday morning in the Hoffman Health Conference Center. So stay tuned for that. And in the meantime, we're glad to be able to continue connecting with you virtually and providing this education. So we're coming to you today from the West Tower Auditorium here at Torrance Memorial, and I'm happy to have our speakers with us today, as well as support from our tech services, media services, tech Mitchell, and Margaret from my office, who's supporting by gathering all your questions from the chat. So this seminar series is called Taking Care of Your Financial Health, and it's brought to you by the Foundation Office and our Professional Advisory Council members. They are a volunteer group of estate planning attorneys, CPAs, financial planners, professional fiduciaries, and others who support Torrance Memorial and help educate the community on charitable and tax estate planning. So we appreciate them sharing their time and expertise with us to bring you this series of lectures throughout the year. We do have a guest today. Cynthia Rustanius is helping Brandon present today. She is not a member of PAC, but we're working on her to be able to join us at some point. So we're glad she was able to come and share the presentation with Brandon. So I emailed everybody yesterday who was registered for the seminar today. You received the handout of the PowerPoint along with an extra handout on some questions that will be talked about today. We do like to hold all the questions until the end, but if you'll please enter them in the chat box as we go through, and as you think of them, feel free to enter them in the chat box. We'll collect all of those and we'll address as many as we can at the end of the presentation. So you'll find the chat box at the bottom in the middle, kind of in the middle of the screen at the bottom of your Zoom screen. If you are not comfortable doing that, you can also call 310-784-4843. And Mitchell will pick that phone up and you can pass along your question via phone. So again, that's 310-784-4843. It shows up a little bit later in a slide because that's my phone number that's forwarded down here. You have control of how you look at the screen. Most of it will be with the PowerPoint and the speaker's face in the bottom corner, but you can play around with that too if you're familiar with Zoom. We will be recording this seminar and posting it on our website probably sometime next week, and it'll be posted there for about 90 days or so. There are a couple still from last year available there, and I'll have more information on that at the end. So I do always like to give a little highlight of Torrance Memorial at these seminars, and I wanted to let you all know that we are launching this month a new campaign for our emergency department expansion. We are on track to see 100,000 patients in our ER this year, this fiscal year, and over the last 10 years, we've seen a 40% increase in visits to the emergency department. So it's tight, it's busy. We're having to close and go on diversion almost every shift because the hospital beds are full. We don't have space for to see more patients. So in working with other area hospitals, we kind of rotate that around. So the time is now to increase the space. So we'll be moving into a second floor space as we expand the department. And this is a 7-year project, about $40 million, because once we get the second floor open, we'll be doing some renovations to the first floor. So we currently have 32 beds and 50 treatment spaces in our emergency department. So once we open the second floor and we have both floors operating, we'll be able to have 80 treatment spaces. And so a nice increase in that for our community. We'll offer some behavioral health rooms, some noise reduction enhancements, and a lot of great things will happen with that. So we're excited about being able to do that. And we hope that you'll be willing to support that too and make your donations. So we also completed our 39th annual holiday festival last December, and it was again a great success with bringing in about $1.5 million. So we thank the community for your tremendous support of that event. And we look forward to this year. It will be our 40th anniversary. So we're trying to come up with some ideas to do some special things for the 40th year. So look forward to more information about that. I like to also mention we do other series educational programs here. Our Miracle of Living health lectures happen typically on the third Wednesday of the month. They're still also via Zoom, and hopefully we'll be in person again this year. At some point on Wednesday, this past Wednesday, there was a talk on autoimmune disease, and that was also recorded and will be posted on our website. We often get questions too about Medicare. In our Torrance Memorial IPA does a monthly session on called Medicare 101. And the next one for that is on January 25 at 6:30. You can find that at torrancememorialipa.org. If you go to that website and then look at their classes, you'll find the link to that. And it's very helpful. Medicare gets kind of complicated, so do join in that if you're approaching that age or just want to learn some more about it. So I mentioned I'm Director of Plan Giving. I work with folks to include Torrance Memorial in their estate plans, and there are a lot of different ways you can do that. This list shows what some of those are. The most common being a bequest by writing this into your trust or will with a donation after you're gone is much appreciated. We are a nonprofit hospital, and so the support of our community is really important in the work we do. I do want to also talk a little bit about, and Brandon or Cindy will probably also talk about this a little bit, but I hope you're aware, if you're taking required minimum distributions from your IRAs, that you have the opportunity to donate right now up to $100,000. From that, if it comes directly to Torrance Memorial, it doesn't get added to the income on your tax return at the end of the year. So it's a great way to make donations to support your favorite charity, which I hope is Torrance Memorial, and be able to count that towards your RMD. You have to be 70 and a half or older to do that. And we do make the folks who do that become part of our Heritage Society, which is the group of folks who have included us in their estate plan. We count the IRA as part of your estate planning. And so we think that's appropriate to include you in that. I did want to mention that the Secure Act 2.0 was passed, went into effect the beginning of this year. And that a couple things were included in there that impacted this qualified charitable distribution. One is that starting in 2024, it will be indexed for inflation. So the maximum amount of 100,000 will increase gradually over time. And also effective this year, you can take 50,000 from that from your IRA and set up a charitable gift annuity, which is a great way to create an income stream for you. So give me a call. We can talk about that if you have any interest in that. So I won't go into the details on that right now, but it is a really great resource to help increase your income. We have a wonderful website with a lot of great resources for plan giving. There, it's shown here at the top of that page, torrancememorialfoundation.org/planned-giving, and some articles and other information there about the various ways that you can put a charitable gift into your estate plan. There's also this really great planning kit there for your personal estate planning. There's a record book and a lesson book, and it's at the bottom of the bequest page. If you click on the bequest on that site, and then you can download it. Email me or call me if you have difficulty with that. I'm happy to send it to you, but it's a great way to gather all of your the assets and all of the information about your estate into one place. And the lesson book is also helpful, although I do hear from some of our professional advisory council members that some of the things in there are not specific to California, but it does give a good general overview. So my contact information is there. If, feel free to give me a call or send me an email, and we'll talk about any questions you have. As I mentioned, we're a nonprofit hospital, so I like to include this too. We welcome and appreciate any of your donations of any amount. It all makes a big difference in how we're able to continue to get the latest in technology and build the programs and services at Torrance Memorial. So there's the information about how you can make a gift. Let's now move into the meat of the presentation, and I'm going to invite one of our co-chairs. We have two people who are co-chairs for the Professional Advisory Council. Karen Pryor is new this year. They do a 2-year term and we rotate them out. So Karen Pryor is our new co-chair, but today with us is Larry Takahashi. He is a certified financial planner here in Torrance. His primary focus is helping clients build strategies for a successful retirement, including creating an effective retirement income plan and minimizing the impact of taxes during retirement and on your estate. So going to welcome Larry to invite Cindy and Brandon.
Good afternoon. So before we get started, I do need to read this disclosure statement. This material is for general information only and is not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, please consult qualified professionals. Today's webinar is entitled Individual Taxation, Wrapping Up 2022 and Planning for 2023. Let me introduce our speakers today. First, we have Brandon Hohm, CPA. Brandon earned a bachelor and master degree in engineering at MIT and served in the U.S. Army for 8 years after college, where he was a ranger stationed primarily in Asia. He then worked in several engineering and management positions while going to UCLA at night for an accounting certificate. Brandon is now a CPA and part-time owner of Medical Accounting Service Incorporated, which specializes in accounting for medical and dental practices, their professionals and families. He also owns and manages several real estate companies across 4 states. Brandon is slowly completing a Master of Taxation at USC in his non-existent free time. And next we have Cynthia Rustanius, CPA. And as Sandy mentioned, Cindy is a guest presenter with us today. Cindy earned her Bachelor of Science in Business Administration with an accounting major from Cal State Long Beach. She worked with an LA CPA firm, also Xerox and PricewaterhouseCoopers, before she struck out on her own to establish her own firm, Rustanius and Norton CPA PC here in Torrance. She earned her Master of Business Taxation at USC while establishing her firm, which specializes in small business and taxation, along with trusts and estates. She also serves as a professional trustee. She has served on several boards and professional associations, and she has been a member of Toastmasters. Her hobbies include rose gardening with over 75 bushes in her yard, also traveling and antiques. So I am now going to turn it over to Cindy.
Thank you, Larry and Sandy. So now we get into the fun stuff. Let's see. So some of the New Year's resolutions that we came up with, we'll be paying attention to every single form that you get. You're going to be getting a litany of forms coming in the next month and 2. Mostly the 1099s will arrive in February, and those seem to be the ones that come later, but K1s will also come later too. Keep good records. I think that's very important. Most people have their own way of doing record keeping. And the main thing is to keep it organized. Anytime that you get your records together, I believe it really helps the CPA or your tax preparer, as well as yourself, so that you don't make mistakes, you don't forget something. So however you do your organization, that would be very key. Different people give you different forms. There's no right or wrong. It's just keep it as best you can. Don't believe everything on the internet. We all know that. I will listen to my friends and family cautiously, deal with notices promptly. I want to emphasize that it is important if you get notices from any tax agency to be sure to let your preparer know. I've had in the past somebody come in 6 months later, throw across the desk an unopened envelope. You don't want to do that because there are time-sensitive responses that are required typically. So do open everything. It's not going to bite you. Most of the time, they're not even right. So make sure to get that correspondence to your tax preparer as soon as possible. Don't be afraid of the IRS or the FTB. Afraid, I don't think anybody should be afraid of them. Trying to get through to them is another matter, but don't be afraid of them. And definitely don't speak with solicitors regarding your income tax. One thing, a word of caution is these days there's so many hackers out there. You might get solicitations. You don't even know if they're going to be a reputable preparer. So I would always say, get a recommendation if you're going to switch, or if you're going to stop doing it on your own, do go to somebody that would be referred by another friend or family member. One other thing, back to not believing everything on the internet. The other one I want to make a comment is, please don't always listen to your hairdresser or your barber, because I can't tell you how many times somebody says, oh, I have this information and could you check into this, please? So actually, sometimes it can be legitimate, but everybody's facts and circumstances are different. So it may be a totally different result for you. One little fact can change the end result. So take that with a grain of salt. Let's see. So common myths, tax tables, these are the agendas that we're going to cover, Brendan and I, today. We'll go over these in much more detail. We don't need to stay here. So common myths: if you don't receive a W-2 or a 1099, the income is not taxable. I think most of you know that's true, that you need to report it. It certainly will get reported somehow or other to the IRS. Sometimes they don't issue the proper 1099 or the proper W-2 or the right reporting form. But just because it's not reported to the IRS doesn't mean that it's not taxable. So that you have to make your own individual decision upon, but it's supposed to be reported. If you set up a pass-through business, so LLC, that you get more deductions. That's not a one-sentence response. There are certain circumstances where it might be best to set up some type of company, but oftentimes that's another one of those things that you hear from somebody, oh, they did this and they deducted this, and their dog, they deducted, whatever it might be. So just be leery. Certainly it's always good to ask, but here in California, another thing to keep in mind is that sometimes there will be more reporting than you would have expected and fees to pay. So you really want to investigate that better. Car salesmen, they love to give you advice, especially now with so many credits available. But even if they tell you, oh, yes, you're going to get your $7,500 credit or whatever it may be that they're going to recommend, definitely check with your tax preparer on that, because there are a lot of credits. So in that respect, they are correct. But there's cutoffs, there's so many different requirements, there's different rules, different makes, different models, different years, used, new. So definitely check further into that, but don't listen and take as gospel that's exactly how it's going to work without checking with your own tax preparer. Emotional support animals deductible as a dependent. Well, that's not going to be anything to work on. Okay. So the U.S. tax, on a different slide here. I think I went too far. Okay, sorry. So on the tax tables, you've probably heard that the tax tables are progressive, and that's how federal and California are structured. So think of it in terms of, we use the example of layered cake. I like to use the stepping stone stairs, where you have your first stair, then you have your second stair, and third stair, et cetera. And those are the different layers. So the highest bracket is 37% for anyone, although there will be some other add-on rates that could come into play down the road, but the highest bracket is 37%. So for those high income brackets, that's what they call their marginal tax rate. And that would be anything at the top tier that would be taxed at that rate. It doesn't taint the lower rates. The lower rates are still going to be at this lower amounts. So keep that in mind, that when you're thinking that you're in the top bracket at 37%, that doesn't mean everything's going to be taxed at 37%. So here's just a table of the different rates in the bracket. So for instance, on the single, and you have a 10% bracket, it's up to 10,275. That will always be taxed at 10%. It's not going to go into the higher brackets of 37 or 24 or 32. That will always stay that way. So it's just added together on the different tiers. So here's an example of a single taxpayer taxable income that's different than the gross income, taxable income of $75,000. And so you have your first layer of 10,275 at the 10% rate. Then you have your second layer at 12%, and that's just for the amount over the first layer. And you have your third layer with the rate of 22%. So that accumulated together and added together is what your total tax will be. So the example is showing that your taxable income creates a tax of 12,117. And then you go to the taxable income. If you thought everything was taxed at 22%, your highest bracket, you would have had a tax of 16,500. So as you can see, that isn't correct. It is at the 12,117. So the lower tiers do come into play. Same type of example for married filing joint, taxable income of 175,500. Excuse me, that's a gross income. And then you have a standard deduction of 25,900, and that gives a taxable income of 149,600. So again, think of the layer cake. The tax is calculated as follows. So the first layer at the 10% bracket, the second layer at the 12% bracket, and then the third layer at the 22% bracket, which gives the tax of the 24,146. So that's the actual tax. That's the correct way to calculate it for the taxable income. If it was all at the 22%, it would have given a calculation of 32,000. So that's just the wrong way to look at it. So don't forget it's a layered brackets. And if you took everything for the taxable income at 22%, I guess, I'm not sure they have the slide here correct, but the taxable income of 149 or 175, the 175 is actually the gross income, not the taxable income. So that's before any deductions. That's not correct either. Okay. So California has income tax system, which is in the same manner as the federal system, and that would be a progressive rate. And their rates go as high as 13.3%. Here's their tables. They don't have all the brackets out yet for 2023. So when we're calculating everything, your 22 tax returns, which we're working on now, will be at these various brackets and rates. They also, I want to mention that they have a 1%, they call it the mental health services percentage, 1% of income, taxable income over $1 million. So some people see that, some people do not, but it is in addition to these tax brackets. So AMT has not been as much of a problem as it has been in the past, ever since they incorporated the limitation on the tax deductions limitation, which is known as the state and local taxation, SALT, is another acronym that people are using for that. So you've probably noticed for federal purposes. This is not for state purposes. So the AMT is a parallel tax system where it's not really the minimum tax, it's really the larger of the two taxes, but it is an alternate calculation. I'm not going to get too much into this because it's very complicated and it's not as applicable as it used to be. But you can see that there's different exemptions. The filing status, it follows the same pattern: single, married, filing joint, head of household, so forth. It is additional tax. It's added on to whatever would have been the normal tax, and it's an incremental amount added on to get a minimum amount to be paid. So types of income. Income here. Okay, so on the W-2, everybody's familiar with W-2s, and then 1099s, most people know what those are. And there's various kinds of 1099s. In this particular situation, it's showing W-2s issued by the employers by the end of this month. And the 1099s, NEC, non-employee compensation, are issued to you if you have in excess of $600 earned from any one particular person or company. The NEC is new in the last couple of years. It used to just be 1099 miscellaneous, and now there's a new form that they've carved out for the NEC. That's primarily because they want to make sure you're going to pay Social Security taxes on it. It's not just income tax, but there will be Social Security component of that, and probably reported on a Schedule C on your individual tax return. The royalties, rents, other income, that's reported on a 1099 miscellaneous. And if it's less than, greater than 10, or I'm not sure how that's written there, $600 again is usually the threshold in order for you to get one. Anything in addition, in above $600 will be reported to you. Retirement plan distributions, the 1099-R. That will be if you get IRA distributions, distributions from a 401k, whatever retirement that you might have, that you're getting funds paid to you. Now, there should be a component on there that shows the breakout of what's taxable and what's not taxable. Many times they don't fill in the taxable amount. It's left blank, and it's up to the tax preparer and yourself to determine what that's supposed to be. Something just to keep in mind is when you do the QCD, the qualified charitable distribution, the 1099 that you receive, the 1099R that you receive, does not indicate the QCD on there. So you have to be careful and make sure that you let your tax preparer know that that has not been deducted from that, and they need to take that into account when they're preparing your tax return. Social Security, you get your Social Security SSA 1099, the investment interest, dividends, gains, so forth. You get various reports for those. Crowdfunding, the 1099Ks that's coming through, those would be reporting, I believe, if it's again more than $600. Gifts with a quid pro quo, legal settlements, often taxable unless there's physical injury, and then that portion would not be taxable. I've seen those 1099s that come from attorneys or from the company that lost the lawsuit, if you will, that those 1099s are not always reported correctly either. A lot of times they'll include everything, sometimes they don't. You have to find out what is the physical portion of the settlement. That also is an area that you need to work with your attorney to make sure they report it correctly, because sometimes the settlement doesn't even have a breakout of what's the physical portion or what is the other settlement for. And it's important because the physical portion is not supposed to be taxable. So do make sure anytime you deal with any lawsuit that you have that broken out. Tax refund depends if you itemized in the previous year. If it was deducted in the previous year, then you would pick it up in the subsequent year. With the SALT limitation and how you probably aren't deducting it, it's not as large a factor as it used to be in the past. Gambling winnings in excess of losses. You want to make sure that your losses are offset against the gambling income. And don't forget, you're not supposed to have any footprints on those tickets that you get from the the racetrack, because they're supposed to be your own losses, not other people's losses. Let's see. So an income court case, just something real life that happens. And this is something Brandon and I spoke about, that the court cases, I think you can Google any court case if you have a name of something. They're really interesting because they're real life happenings. And in this particular case, this lady was the one that was the sole breadwinner. She and her husband filed a joint return for the tax years 2012 to 2015. And her husband was a stay-at-home, well, she thought he was stay-at-home and didn't work. Well, so she said, and that was what the whole court case was about, that he did not report consulting income for 4 years. She thought it was a gift from his mother, from her mother-in-law. And so when they went through an audit, and they went through 1 audit, 2 audits, 3 audits, they kept getting audited because they didn't respond properly to the first audit. So what happened was, she said, well, I didn't know he was getting this income. I'm going to file as innocent spouse, and I shouldn't have to be responsible for these taxes. So the whole court case went through many hoops, and they didn't respond to most of the things that they were inquired about. And so as it turned out, the courts said, no, you had to have known what was going on, and they disallowed the innocent spouse determination. So I don't know what happened after that, but she lost the case. Exclusions from income, gifts and inheritances, life insurance premiums. Now, one thing to point out on life insurance premiums is that the settlements themselves are not taxable typically, but a lot of times if they don't pay within 30, I think it's 30 days or 60 days, there is an interest component that has to be added by the insurance companies to the payment. And that interest portion is taxable. So keep that in mind. Sometimes they issue 1099 INT for that, and sometimes they don't. But do keep in mind that is something that would be a component that would be taxable. Disaster relief payments shouldn't be taxable. The 14 days or less rental income, that one can be interesting. That might be something to explore if you have a corporation and you might use your personal residence for business on a specific day that maybe your corporation can pay for business purposes. And if you have less than 14 days being paid, that may not be taxable income to you individually, but it possibly could be a deduction to your corporation, or if you have a partnership with other people, not a single member LLC won't work. Tax-free municipal bonds. For California, you have to be careful. It's different than federal. The federal rules, if it's a municipal bond, it wouldn't be taxable to federal. But California only accepts California municipal bonds to be not taxable to California. If you have out-of-state bonds, those would be taxable to California, although not taxable to federal. So it should be broken down on your 1099s that you receive. Most of the time it is, but just be careful about that, because California looks for those things specifically. Public welfare benefits wouldn't be taxable. And again, back to physical injury, legal settlements, or wrongful incarceration settlements. Let's see. Okay, this court case, I do remember hearing about it when it occurred back in 2018, and they're still working on this. This is it's a sad case, but it always gets back to taxes. And here was a Monsanto, which is now bought out by Bayer AG, is still handling cases from this. This relates to the Roundup, and there was a component, I'm not sure if I'm pronouncing it correctly, but the component of glyphosate is the one that's questionable. This was a groundskeeper. He was, I believe, 42 years old. He was working for a school district, and he was the groundskeeper spraying. He always suited up. He always had on his mask and his overalls and whatever so that he didn't get sprayed. But one time he was spraying and he got dumped on, and it just flooded his whole outfit, his face and everything. And a few months after that, he started developing rashes and things like that. And it turned out that he ended up having lymphoma, the non-Hodgkin lymphoma. And so he decided he wanted to sue for Roundup. So he did sue and he did win, and he received, the initial award was $39 million. Oh, excuse me, it was $250 million plus 39 for physical injury. They've reduced it down to 78, and now I think it's at 21 million. I couldn't find if he's still with us or not, but he did take it through, and his reason for taking it through was because he doesn't think he'll be around, but he wants his family to have the funds, and he wants other people to be aware of how this could be detrimental to their health. But the bottom line for us in taxes is that I don't know if they had a breakdown of, after they reduced the settlement, how much was for the physical portion and how much was for the compensatory, for the punitive, because the punitive would be taxable. So again, I don't know if they ended up giving a breakdown. I'm assuming that they did. But the attorney fees related to this have not been handled very well, in my opinion. They would be a miscellaneous itemized deduction, and sometimes they don't end up being deductible depending upon how the settlement is taxable. And it's not an easy way that they have the attorney fees being deductible, not always turning out to be deductible. And federal doesn't have miscellaneous itemized deductions anymore anyway. California still has them. So you just have to give your preparer the numbers and they can see how it works out for you if you have any of these situations. So Social Security and retirement income. Let's see, what do we have here? So retirement income includes from your IRAs, your RMDs, and there's a yearly calculation, and they have life expectancy tables to determine, and they've just changed the tables and now they go up to 120 years. So, and I just read yesterday, I think that the oldest lady in the world died at 119 in France. So I guess they're not so far off, although I don't know too many 120-year-old people or 119-year-old people. But also under the Secure Act, they just changed that the RMDs, they used to be 70.5, then they raised them to 72, and now starting, I believe, next year at aged 73, and then eventually it's going to be going up to age 75 starting in 2033. So they're realizing most of the time that people are living longer and they want the monies set aside for a longer time frame. So that's one of the things that you probably want to work with Larry on, is when do you start taking it out? Do you want to take it out sooner than later or leave it in as long as you can? But you do have to start taking it out when you reach the specific age, depending on when you're born. Secure Act. So there used to be penalties, there always have been penalties if you didn't take out your RMD when you reached your full retirement age. And from my experience, that's not uncommon to have people forget to take it. The banks didn't remind people, people forgot, and you're in your 70s, you're going to forget things anyway. So it's one of those things that is not uncommon to forget. And the penalties have been decreased from 25% to 25% from 50%. The only comment I make on that is that I've actually never had a taxpayer that's paid the penalty, because there is an exception. You can do a reasonable cause filing with your tax return to indicate that you had reasonable cause why you forgot. And I've never seen one rejected. So I've not had to ever have a taxpayer pay a penalty. And if you do, you might want to investigate a little bit further. So in 2024, they're also going to have RMDs are not going to be required from the employer Roth amounts. Again, the age increased to 73 and to 75. So if you want, you also can delay until, I believe it's April of the subsequent year from the year that you turned these ages 73 or 75. And you can push it into the subsequent year sometimes. The only downside of that is that sometimes you will have 2 RMDs in 1 year, and that may not be advisable. So you just want to plan with your planner or your CPA as to what might be the best for you. Qualified charitable distributions, as Sandy was pointing out, that now has the one-time gift up to 50,000 beginning in this year, 2023. And they apply for the CRT, a charitable remainder annuity, and or the charitable gift annuity. So there's 3 different types of gifts that you can give one time up to 50,000. And I think that's a pretty good thing. Starting in 24, employers will be able to match employee student loan payments with matching payments, 529 plans. I like this one. This 529 plan, everybody's probably pretty familiar. That's the educational fund set up for kids or relatives or somebody that you want to have good education. So the 529 plans, a lot of times you don't know how much somebody's going to spend on them, and there's leftover after they finished their college or their advanced degrees, whatever they've been using it for. And so now they have this provision, whereas the beneficiary can, if the 529 has been held at least 15 years, then they can take the remainder up to $35,000 and roll it into a Roth IRA. So that's new, and I think that's a really nice benefit to have, but there are some requirements that have to be met in order to do that. Social Security, everybody knows about Social Security. This is the way that they have in this particular slide, how you earn the credits to get to receiving Social Security when you start collecting it and how much you're going to get. So this is the process that they use. I won't belabor how they calculate it, but they do take the average of the highest 35 years of income adjusted for inflation. You can go online and look to see how much you expect to get if you aren't receiving it yet. It's a good tool to use to get signed up for Social Security online. If you need to make an appointment, the number is 1-800-772-1213. And I understand people that have called and can get through that they're very helpful. So I encourage you to make sure to talk to somebody if you're not sure. Your CPA may or may not know everything about the ins and outs of Social Security because it's just an own animal in itself. So you can take the benefits at any time upon reaching age 62, and you become eligible for Medicare at age 65, and you're entitled to your full primary insurance amount at age 67. And there's calculations if you wait until 70 that you'll receive that much more, but you don't get dinged if you take it at age 67. For age 62, one of the things that people learn, should I take it now? Should I not? That can be a difficult decision, but you have to look at a lot of things depending on your health. You know, some people, their parents both live to 95. I think then you probably want to wait till you're 70. If you're younger and you always have health issues, you may want to start it sooner than later. But that's a very personal decision, but you should examine it and look. For working in Social Security, once you reach your full retirement age, you don't get a reduction in your Social Security. It's only when you're getting it before your full retirement age that they do have a reduction in the income. One of the things that I get asked often is how much is going to be taxable. That's different than how much is going to end up being reduced for how much they work. Somebody's working still and it's not before their full retirement and they're receiving Social Security. So it has to be calculated, and Social Security will ding you for getting Social Security before full retirement and working. But there is a threshold in 22, it was 19,560. And in 23, it's going to be a bit higher. They did index it for inflation. It's 21,240 for 2023. And then for if you're at full retirement age in the year that you retire, then it's 56,520 for this year. Last year was 51,960. So one of the things I want to point out, though, on the earnings is the taxability for the Social Security. It's entirely different than how much you earn before they start reducing the Social Security benefits. The Medicare premiums, that is a function of how much you make. So with your income being higher, they will charge you higher Medicare premiums. If it's in the year that you retire or something, you have a life-changing life event, then they may not use this table. You can ask for an appeal. They usually just calculate it based on 2 years prior. So if you're in 23, your Medicare premium is based on your 21 income. For 24, it'll be based on your 22 income because you haven't filed your 23 return. That's why they do it on the year before that. But if you have retired or your spouse passes or there's some reason why you've had a big change in income, that's not the norm, you can go into the Social Security office and you can get that appealed. And they're pretty good about looking at that and recognizing it. Capital gains and dividends, they have their own progressive table, but they've just got 3 different tiers, either 0%, 15%, or 20%. And so those are carved out from the ordinary income and compared to the ordinary income. But I've had somebody, you can reach as a married filing joint, 83,000. If you had 80,000 of capital gains and no other income, you would pay 0 tax. So there is a component that gets split out to the ordinary versus the capital gain. And I might add that California does not have a special rate for capital gains. They call it capital gains, excuse me, but it just falls in with all the other income and there's no separate calculation like federal has. So federal does have a benefit if it's long-term capital gain. Capital losses, those are netted against capital gains. And I think this last year in 22, the first highlight here of tax harvesting, everybody was doing tax harvesting because there were so many losses to be had. And hopefully, if that was your case, you have some losses now that are captured. You may not be able to use them all in the current year, but they're on hold until you do have capital gains down the road. So that's always good to have. The other thing that people do that I think is very good is the gifting of appreciated stock to lower your income because you do get a deduction for it. There's a limitation, but most people don't hit up against that limitation. The gifting of appreciated stock, you do not have to recognize capital gain. You're taking a deduction for the fair market value, but not recognizing a gain. It's a really nice thing to look into if you haven't already been doing it. And that's the donate the appreciated and avoiding the gain stock. And I think that is end of my portion, and we will now have Brandon.
All right. Thank you, Cindy. Just a minor point on the capital losses. We have a link down there at the very bottom about huge tax bills. So every December, you're meeting with your CPA to do final year-end tax planning, and the tax preparer will ask about capital gains and losses at that point to try to optimize and see if they're harvesting available. So I'll give an example. One of my clients came in early December, and on their mutual fund, on their capital gains that they had for that mutual fund was only a couple $1,000. within a few weeks at the end of December, that was above $60,000 on a capital gain. And Vanguard was pretty infamous on this last in 2021, where a lot of our clients just had enormous gains that they just were not expecting. They didn't get any cash out. It was just a rebalancing on the fund. So a lot of the retirement funds do this at the very end of the year, in the last 2 weeks of the year. So you need to check your statements to make sure that you don't have this big surprise waiting for you during tax season, because the tax bill technically is due on January 15th, not in April. So you can also be hit by a huge penalty as well as, you know, a big tax. So just be aware of that. For any type of investment income, there is an additional surtax on the federal level. It's 3.8%, and it kicks in when your income gets, well, if you're single above 125K on your AGI or modified AGI, and then that goes up 200 and 250. But we do see that kick in on any type of investment income like interest, dividends, royalties, rents, basically your passive activities for investments. And it's similar to the AMT, where it just kind of kicks in on the side, and you notice it on page 2 of your 1040, where it's like, oh, additional tax, that's nice. So it does not include it's not affected by wages, unemployment, Social Security, alimony, or interest-free income streams. So this is just further on passive income on net investment income. So just be aware of it. It's something that's unavoidable, especially as you get older and your investments start kicking out more interest and dividends and things like that. It is going to be an additional tax that you just need to accommodate for. How to reduce it? A little difficult, especially with the Tax Cut and Jobs Act in 2017. There is investment interest that you can offset a little bit for, and also California will allow miscellaneous deductions against it, but there isn't much to it, unfortunately. All right, on to the next section. We're going to talk about credits as well as deductions. So for credits, there are a bunch of them. The child tax credits begin about our max about 2,000 per qualifying child, and then also 500 for other types of dependents, such as live-in parents, or adult children with disability and things like that. So there are those credits that are available. For child and dependent care, you get that depending on your AGI. So it has increased significantly over the past couple of years, but it's you get this credit from daycare expenses, preschool, summer camps, things like that. And it's just documenting who provided the care, their EIN or social security number, and just making sure you capture the total cost. But both parents have to be working for this to apply. Adoption credit is about 15 grand in 2022 and increases with inflation. I will tell you that it does not cover adoption, not even close. Those costs are considerably high. But it is at least a nice deduction for parents to have. And then there are some saver credits for retirement. So as part of the Secure Act, I believe, you do have some premium tax credits with healthcare insurance, which is required by California. And that's when you put in your statement from the insurance provider, and it'll kick out a credit if your income was low enough to keep it or get it applied to you if you didn't take it when you were taking out the insurance premiums. And then there's some other items like the educational credit and EITC, and these are all for lower income or for students. For the next deduction, next tax credit, which is kind of nice, the Inflation Reduction Act of 2022, that was the largest effort in history to promote reductions in greenhouse gas emissions. So this was a big bill, and I believe it was passed in August. So we've had a little bit of time with it. The clean vehicle credit for individuals is probably the part that everyone listening in is going to be most interested in, where it raises the credit up to 7,500, or at least keeps it sustained at the 7,500 level for EVs, hybrids, and hydrogen vehicles. No longer restricted by the 200,000 limit. This was affecting Tesla and GM, I believe. There might have been another car maker, but I know GM and Tesla are part of it. So that's no longer in play. However, there are restrictions now. The final assembly of those vehicles have to be done in North America, and your AGI cannot exceed these limits, which are on the slide there. The retail price also cannot exceed a certain amount, 80K for SUVs and 55K for vehicles. I think you might have noticed there was a press release by Tesla reducing the price of their vehicles over the past few weeks. This was a big driver for that. And then you also have leased and used vehicles also in play. However, for EV vehicles and such, you have to be cautious on used vehicles, especially with the battery, just word of caution. And one interesting part of this is that the credit can be transferable to the dealer. We're not honestly sure how they're going to check for this. But it is in the tax code now. And so that may be an offering that you get from your dealership if you are in the market for a new clean vehicle. Some other items are the energy efficient home improvement credit. This was always just like a meh part of the tax code where you got $500 lifetime for installing energy efficiency, windows, doors, roofs, insulation. It went pretty quick, especially once you replace one window, it's gone. So 2023, they realized that, people pay more than $500 to improve the energy of their house. And so this is up to 30% of the cost with a $1,200 annual credit going forward, which is a nice plus. You also have the residential clean energy credit. Solar, fuel cells, and heat pumps are the most popular. I don't think there are many heat pumps here. That's mostly in colder weather. But we now get the 30% credit back in play. This was reducing down to 26 and eventually down to 22%, but it's back up to 30%. California doesn't have a similar credit, but it is, for instance, if you install a solar array on your house, it costs anywhere from 30 to 35K or so. You get it on a loan agreement. And so you're just paying back a loan at 3% or so. You get the full credit once it's installed. It has to be installed and functioning for you to get the credit in that year. And so you'll get maybe a $10,000 tax credit for that year. And then you have a 10 or 25 or 30-year loan on that property. So it is a nice benefit, a nice big uptick for taxpayers to realize. And then California, again, it doesn't have the same stipulation, but it does have rebates, especially for fuel cells in areas that are prone to lose electricity. I've seen that. That's a few $1,000s. However, putting fuel cells in your home, that's a whole nother conversation that, the value of is questionable. For deductions, we have a bunch. So you're either on a standard or an itemized deduction scale. On the right there is the standard deduction limit. That applies to everyone. So if you do not use your itemized deductions to get up to those limits, you're going to be in a standard deduction bracket. So if you give a few more dollars to charity, or if you have gambling losses, that tends to be the biggest surprise for my gamblers. And if you're in that standard bracket, you don't get those additional deductions. You just get the standard amount. So we'll go through a bunch of these here. The medical and dental, I have a slide on the SALT tax, which is what Cindy introduced with the AMT. We're going to talk a little bit about that. Interest, charitable contributions. Won't really cover casualty and theft losses because we typically are not in a federal disaster. Until this year, almost the entire state of California is a federal disaster because of the rainstorms. So that is something to consider for your taxes if you have any loss due to water. Conservation easements, was made pretty popular by Trump. He made a lot of money off of that. So the courts really started paying attention. And then miscellaneous deductions, that's tax preparer fees, your investment advisor fees, your safety deposit box, things like that. Those are suspended, except in California. California is special. We are on the old tax system and our own special system. So those still apply for California. So just if your income is high enough or your fees are high enough, then don't forget those. For medical expense, they have to exceed 7.5% of your AGI to be deductible. Things are included: medical premiums, your dental premiums, co-pays, eyeglasses, at-home care. The part where this becomes a major deduction is if you have at-home care, which is quite expensive, or living assistance, or if you have some major surgery that you paid for out of pocket, then we tend to see this expense come into play as a deduction. Some things that aren't deductible, it's usually kind of cosmetic, I would say. So if you have any plastic surgery or gym memberships or vitamins or elective, those tend to be not deductible unless done for significant health reasons with a doctor's note. And then at the very end there, in-home pools, air conditioning, saunas, there are a ton of tax court cases on these, but you tend to discount the amount that you pay for these items, even if you have a doctor's note, and apply at least the amount of basis that's added to your house. You cannot deduct that as a medical expense during that year. You have to compensate for any value and appreciative value that you bring to your residence for those types of items. So the salt tax, that is, it's been interesting to find a way around that over the past couple of years. So the state and local taxes, property taxes, have been limited to 10,000 on the itemized deduction. California is still under the old rules. And so many states with high property taxes have been trying to find a way around this. They did find a way with pass-through entities. So if you do have a pass-through entity like an S Corp, an LLC with multiple members, talk to your tax accountant. If you already are not taking advantage of this, you're a couple of years behind, unfortunately. Qualified residence interest. This is a deduction on your mortgage. This is probably the biggest factor to bringing you from a standard to an itemized deduction that we see. So if you had a mortgage in place before December 31st, 2017, your limit on the mortgage was $1 million on your primary or secondary residence. And this got decreased down to 750,000 for married filing joint, or single, it's half that, or married filing separately, it's half that. So you're on this, especially, we are seeing a lot of paper audits. If you're given that interest rates over the past few years have been so low, the IRS is looking at the amount of interest you're taking a deduction on and sending out an automated letter saying, it looks a little too high on your interest deduction. You may want to check that. And this is what we think it should be. That's not a threat. It's just the IRS's computer algorithm checking a certain threshold and just making sure that it is what it's supposed to be. Those may go away with the interest rates going back up though. And then the Voss case, I just bring this up because I had to deal with it over the past few months. If you have two unmarried co-owners of a property, technically they get double the deduction on the mortgage interest, up to $2.2 million, which is fantastic. However, when that couple gets married, that goes back down to 1.1 million. Under the old rules of 2017, you're restricted to 750,000 if you bought the house and secured the mortgage after 2017. So the court actually said that we agree this is a marriage penalty. We're sorry, but I had clients who specifically got their deed separated between each individual, and then they got married 4 days later, and their accountant told them that they had to, they could deduct the entire amount up to 2.2 million. And I had the opportunity to tell them, no, that's incorrect. So that was fun, but it happens. This one is a pretty famous case from 2015, but it does show they're in California too. So it does show one of the minuses of getting married, unfortunately. Charitable contributions, we're gonna talk a little bit about that. We're if you're 70 and a half or older, you can make a distribution directly to a charity. You don't recognize that in your AGI. And your 1099, as Cindy said, does not include a little line item saying that that money went to your qualified charity and you shouldn't have to recognize it for income. So just be very careful and notify your tax preparer that, in fact, if you get a 1099-R and you did give it as an RMD directly to charity, that you need to notify them that that is in fact not taxable. For your contributions, they tend to fall into buckets, 50, 30, and 20%. So a lot of people expect, you know, if I give to charity, it's going to be 50% deductible. That's not the case. It depends on your tax bracket as well as what type of 501c organization you give to. So there are a lot of different rules behind this. And so if you give to the most common that I see is to fraternities and sororities, those are only 30% deductible, not 50%. So just keep that in mind that, you know, if you are charitable, that's the primary reason to give to charities. But if you are looking for the deduction as well, look at these stipulations here and make sure that you are, if you have a choice, might as well go for 50% versus 30 or 20. These are carried over for 5 years. So we always have some clients every year where their carryover expires because they just gave too much. And so it's a nice thing. We try to extend it as much as we can, but it's 5 years or 15 years for conservation. So the IRS is always incredibly hard on proof. And we always have a couple audits every single year on major contributions. And so the kind of takeaway on this is you have to get a letter from the charity verifying the amount that you gave. It has to be a letter. It can't be receipts. It can't be a credit card statement. You have to get a letter. And I know Torrance Memorial gives a letter for every single dollar that's donated. And this little chart here kind of breaks down what to do if you're giving cash or property donations or what have you. The part that gets most people is when they start giving objects or cash above $5,000. Then you get into a lot of sad stories of the IRS saying, no, we're going to disallow the entire amount. You have to get everything to the T exactly right on those donations, or the IRS will come in and disallow the entire amount. And we have some court cases. Brown versus Commissioner, we had a church founder and pastor denied his deductions because he had only receipts. He didn't have the letter and it was after the fact. Even though the charity will come in and tell the IRS personally, yes, we received this money, but we didn't provide a letter, then it gets denied. So we've had that audit as well from, I believe, Montana, where we had credit card receipts, but not the actual letter in time that we filed the tax return. And so the IRS or tax board can say no. Platts, they donated a house. And unfortunately, the appraisal was not exactly correct. So the IRS denied the entire thing. Man, same thing, donated property. They were going to renovate, but they found out it was too much. And they got an appraisal, but the appraisal didn't include everything. That the Mann family actually kept a few items from that house, and that eliminated the entire certified appraisal as being accurate. And the IRS denied the entire thing. So these all kind of relate to similar cases. In 2012, there was a Muhammad case where the IRS came in and they denied a $15 million donation, the entire amount, because the appraisal was done by the taxpayer, not a certified appraiser. So IRS is very hard on this, and that's because Congress was incredibly strict. And one of the line items from the Muhammad case, which is not here, was that the tax court actually said that the problems with misvalued property are so great that Congress was quite specific about what the charitably inclined have to do to defend their deduction. And we cannot in a single sympathetic case undermine those rules. That is why the IRS is so hard on this. It's either all or not. You have to follow every single rule to a T in order to get a deduction. And we were in an audit for 4 years for one of our clients who donated an apartment building to a homeless shelter. The IRS wanted to eliminate the entire thing because the appraisal had 2 certified signatures and the IRS tax form only has 1 spot for a signature. They wanted to deny the entire $1 million+ donation because the IRS form only had 1 spot for a signature. That was it. So we ended up settling and got most of it, but those are certain situations where it kind of gets into the ridiculous side, but the IRS is reading Congress's intent very strict on this. So just when you give something large, just make sure you follow the rules exactly. That's the takeaway. For other miscellaneous items, I think I'm okay on time. Identity theft is a big one. You can get a 6-digit code from the IRS if you're concerned. Actually, it's quite recommended for everyone to get one. It's easy to do. It takes a few minutes. You have to be aware of scams and everything else as usual. That's across the board. For IRS, they never call first. However, if you really do something to question your tax form or what have you, you will be assigned a person directly to call. So you just got to make sure, as Cindy said, if you get any forms, make sure you work with your tax professional. And you know, the IRS, they're just people as well as franchise tax board. If you can wait the 2 hours to get them on the phone at that time, I kind of like talking with them and getting on a personal level at that point, because you did get through and it's kind of a nice thing. And they do want to help you. They're not trying to try to get as many dollars from you as possible. So they are people. Virtual currency, this is on the 1040 form at the top. If you owned or were given or gifted, traded, what have you, any type of virtual currency that passed through your accounts or under your name, you need to make sure that you say yes or no that you owned it. And starting in 2023, you're going to see 1099s come out for crypto transactions. And so the governments are getting pretty hard on crypto right now. They're trying to get rid of a lot of the fraud and they're going after people and making sure that all the records are disclosed. For retirement, you have for just IRA contributions at $6,500 with another $1,000 catch up if you're 50 or older. And so this can be a minor deduction for you. And if you or your working, your spouse does not earn income, you can still make contributions for both of you. And backdoor Roths are still in play. And so that's a window of opportunity, especially if you're in between retirement and taking Social Security and R&Ds. You have that period in your life where your income may go down quite considerably. That's an opportunity to convert to a Roth so you have some tax-free income going forward. But again, talk to your advisors on that one. Federal and state gift tax, this limit, tax gift exemption limit keeps going up each year for inflation. It's now up to 12.92 million. And then tax-free gifts per recipient is now $17,000. So a married couple can give up to $34,000 to one person without having to file a 709 or anything else. So if your estate is up to this level, which, you know, we're talking about 26 million, give or take, for a married couple, this is something to talk to your advisors about if you want to convert it to irrevocable trust or what have you. There are some plays here that are going to sunset in a couple of years. Some court cases related to, estates. We had Demuth, that was recent over the past few months that came out. So personal checks written by the decedent before his death but not paid actually became part of his gross estate. So the court falls back on intent at that point. And then we have Warren versus Commissioner. The estate gifted the entire LLC as a family-owned LLC worth about 25 million fair market value to a church and a family foundation, the tax court actually reduced the value. It wouldn't accept the certified appraisal because it's a private interest, and those are always reduced because of the marketability. And we see this a lot. I do a lot of real estate syndications. When there are sales in between members, you have to discount it roughly 20-30% or so, because there is no outward valuation in the open market. It's very difficult to sell. For California, again, completely different tax system than the federal government. We don't do anything standard. These are some of the recent rules. You have to have healthcare. That's from 2020, but just a reminder, we are at a hospital. Cal Savers, anyone with 5 or more employees now have to contribute to a retirement plan, or they don't have to contribute, they have to offer it to all their workers. AB 150 is that SALT tax loophole that was created by the state so that small business owners can get around that $10,000 restriction. The Measure ULA, that's the mansion tax. You may have heard about that one, but they're going to start taxing Los Angeles property sales above 5 million with a little surcharge. This is also in San Francisco. It's been there for a few years, but so properties will be affected by quite a bit. And then AB 158, if you have union dues, you now have a tax credit. Relief payments, this is a fun one. So I just got a text while sitting here. One of my clients got a debit card in the mail. And so a little surprise, you're finding a lot of people are getting debit cards or direct deposits over the past couple months, anywhere from $200 to $1,050. And it's tax-free. If you're a married couple and you make less than $500,000, you're going to get a card. And there is a website and a phone number where you can estimate and see where it is. This is excluded from California income. It's directly on the website. However, you are going to get a 1099 miscellaneous form for $600 or more. So is that taxable federal? We don't believe so, per the general welfare exemption on the federal tax code, but it is something to ask your taxpayer just to make sure, because the federal government hasn't outright said that is tax-free. California did. For filing requirements, you have to file if your self-employment income is above 400, or if your income is over the standard deduction limits, and they're there for 22 and 23, upticks a little bit higher. Nanny tax must be prepared if you pay a nanny, housekeeper, some household employee above 2,400 for last year. That goes up to 2,600 in 2023. And tax returns, we have 3 days, Monday. We will begin submitting tax returns as early as January 23rd. I will warn everyone that a lot of the tax forms, especially on the state side, are not complete yet. So that tends to be a delay in processing tax returns, especially for businesses. So, but they will begin accepting them. Paper returns, just as a warning, the IRS is behind about 6 months on opening up their mail right now. So if you file a paper return, just be patient. And the big news from the past few weeks is that California is a federal disaster area because of the rain. And because of that, the IRS and California believe that you can't file your taxes on time. So they gave us an extra month. So take that with a grain of salt. Talk to your tax preparer. This does not mean everyone procrastinate to May 14th. Just make sure that it applies to you, and talk to your tax preparer about before you extend it, everything else. But otherwise, if you go under the normal filing deadline, it's April 18th, unless you extend. As part of an attachment, we are including these little questionnaires, 5 pages or so. It's something to give to your taxpayer just to make sure that you're including everything. And That is it. We have questions.
All right, thank you, Brandon. Thank you, Cindy. And my question monitor just blanked out. Hey. One moment. Oh. Okay, we're just queuing up the questions here, so we're going to get started in a second. All right. First question. What are the benefits of having an IRS security PIN with tax calculations? And then how do you get a security PIN?
So the secure ID pin, you can go onto irs.gov and it's you'll see in there that you'll have an option to get a pin assigned to you. It's all done online. I did it with a client where we did it with her personal cell phone where it takes a picture of you and it verifies your ID. And we got it within a few minutes where it assigns a 6-digit pin. And it prevents people from filing a false tax return on your behalf. Because to file the return, you need this 6-digit PIN to be accepted by the IRS. If you don't have it, then the IRS will reject it, within 24 hours. And so it's the way to prevent false tax filings on your social security number, which at this point, there have been so many leaks of your information, government, Equifax, Target, et cetera, Microsoft. I think your information is out there at this point. So it is a way to protect, to make sure that there is no tax return filed under your social security number and have to go through that correction process.
One thing I might add about that is that they will give you a new one every year.
Mhm.
And if you do not have it, you will not be able to e-file. So you want to make sure they send it to you in a letter, typically in January. So if you have one, you should be getting one, but it will be new every year. You can't use the same one the entire time.
Okay, next question. What is QCD under income page? So I'm not sure if they're asking for a definition on one of the pages, qualified charitable distribution.
That's it.
So, okay, I think that's what they're asking for. Next question, for the middle class tax rebate, do we report on the federal return? If so, where? Do we have to report on state return? I think you touched on that, Brandon.
It's my understanding that it probably shouldn't be reported. And I was kind of befuddled to hear that they were going to issue a 1099 possibly.
We had clients already receive 1099s if it's 600 or more. So it's just working with your tax preparer to make sure it's not taxable if that's the situation.
Okay, great. Next question, what can a CPA provide a client versus a certified tax preparer? Are there real benefits and protections to have a CPA when getting your annual taxes prepared? So the benefits of working with a CPA versus someone else. Maybe an enrolled agent, I'm not sure.
Yes, yeah. Well, the tax code is published. CPAs undergo a lot more training and education. Doesn't necessarily mean they're better. But that's kind of discrediting Cindy and I at the same time. So, but it is, there are some very excellent enrolled agents out there, and there are some very excellent CPAs out there. So it's up to your discretion. I have come across with new clients, some very horribly done tax returns in the past that I had to correct, and I've seen some good ones in the past. So it's an individualized question. Comes down to trust and, you know, education and there are a lot of aspects that go into that question. I'm sorry, but yeah.
I think also we do have CPAs do have 80 hours that we have to get every 2 years of continuing education. I'm not sure what the EAs have or not, but I do agree with Brandon that there's some good EAs out there as well. Maybe even tax representatives before the IRS that are allowed to prepare and sign returns, but you just have to really get referrals and talk with them, interview them if you want, and take it from there. It's going to be very individualistic.
Thank you. Next question. I'm expecting an inheritance money from the property from my late husband's share from a foreign country. When I bring this money, do I have to report to the IRS and pay taxes in the USA?
Yes,
Yeah.
is the simple answer. There's definitely reporting requirements that have to be done as to whether it's taxable or not. You really would have to, it depends. I mean, typically an inheritance isn't usually taxable, but you would have to check with your preparer to be sure. But you definitely have to report income coming in. There
Yeah.
are specific forms for foreign reporting.
That's the FBAR requirement. You don't want to leave that one out. It's a $50,000.
It's a huge
Minimum?
penalty.
Yeah, if you leave something out. And yeah, and California, by the way, believes every dollar you make across the world belongs in California to be taxed. So just keep that in mind. So.
Thank you. Next question. What is tax harvesting? So I think just a little expanding on that.
Sure. When tax harvesting is when you have a capital gain from, for instance, stock sales, you sell stocks at a loss to offset that gain. So if you're looking at a $10,000 gain at the beginning of beginning of December, you look at your stocks that have a unrealized loss of $10,000 and you sell those and they combined make $0. So you have no taxable event for that year.
So tax harvesting, you have to be careful in anybody that's going to be selling, unless you're doing it on your own, that you have to be careful not to run awry of the wash sale rules, where then the loss would not be recognized. So I believe it's 30 days. If you buy the same thing, then wash sale applies, and you have to be careful you would not be able to use that loss.
Great, thank you. Next question. Can you please explain further the 0% tax on capital gains?
The
0% tax, so I think it's
Oh.
the bracket.
Yeah.
The 0% is if it was only capital gains and you had up to the bracket, I think it says 83,000 on one of them, and it was simply only that, then you have no tax to pay for federal. That's not going to be the same for California, but the 0% is just a bracket. And if it's only that income that you're receiving, then you wouldn't have any tax to pay. If you have other ordinary income, then you have to see how much might be taxable depending on the other income that you have. But if strictly capital gain, then up to a certain amount, you would not have to pay any taxes on it.
Thank you. Next question regarding healthcare expenses. I will itemize this year as I had surgery and out-of-pocket expenses greater than the 7.5% of AGI. Is only this surgery deductible, or are all of my medical expenses in 2022 deductible?
Everything. Add all your medical expenses, prescriptions, mileage, if you travel out of city and have hotel bills, that would be inclusive. So everything, it's not just that one surgery, but that once you're over the threshold, add everything in that you can think of that would be related to medical.
Okay, great. What is the phase out range for annual income to be eligible for Roth contributions for spouse?
It's in the hundred.
Well, it depends on if you're
130.
covered under a plan or not under a plan. I can't
know
answer
the
it that
range.
way. It's too general.
Yeah, it's a little more complicated, but, okay.
It's not that easy, sorry.
Next question, are home renters that work 100% remotely eligible to take any deductions on rent, electric, gas, internet? 100% work from
Right.
home.
So the home office, maybe? You can, so if, as a W-2 employee working remotely, you cannot deduct those expenses because the TCJA Act of 2017 got rid of itemized deductions. If you're an independent contractor or a sole prop or, have your own business, then maybe some of those deductions can come into play for home office, travel, what have you, from residents, but it's a very individualized facts and circumstances question. Just if you're talking just from a W-2, you get into other issues such as state nexus and some other issues of working in another state, even remotely. Where does that income originate? So, yeah, it's a much longer conversation, unfortunately.
And California is different than federal treatment as well.
Yeah, but yeah, so if you are a W-2 employee, what I would say is work with your employer and see how much they can pass through as a deduction through your salary as a benefit. Even if you need to reduce your salary a little bit for them to reimburse you costs like internet or rent or things like that, that we tend to see that quite a bit. If you work for a small enough company where they can accommodate in some type of cafeteria plan or small benefits plan or something like that.
One other thing to remember is that the area that you would be claiming to be your office and home has to be exclusively used. It doesn't have to be the entire room. It would just be perhaps a specific desk or something like that. But it does have to be exclusive use. So if it's a dining room table and you clear it off to have dinner at night, then that doesn't work. But generally, it's not a huge amount of deduction if you're already taken. If you own your home, you already deduct your property taxes, your interest anyway. So sometimes that's not a huge deduction, but it's something to look at, but talk it over with your own preparer.
Okay, thank you. And our final question. I am a freelance contractor. I ended a longtime gig on December 31st. And I'm searching for a new gig this year. Can I still itemize business expenses in 2023 if I do not have earned income?
Schedule C, they said.
Well, it doesn't mention it.
Independent.
They're freelance contractors.
Yeah, this
So,
is a
presumably
lot of
Schedule
court
C then.
cases. So if you're not making any incomes, the courts have shown that you need to put aside those deductions, and you're talking about depreciating or amortizing some of those deductions. And then you also get in the conversation of hobby versus an actual business with the intent of making a profit. There was a court case last year, 5 years, or I forget the name. You have to be careful on taking the deductions in the initial year that you are not making any profit. I mean, that's a little bit of a takeaway, but we can send you some court cases on that as examples. I just emailed it out too. I'll remember it after.
All right, well, thank you so much. I'm Sandy, I'm back. Thank you, Larry, for asking the questions. Thank you, Cindy and Brendan, for your great presentation today and answering all those questions. And I know you're all giving them a round of applause at home. So we appreciate that. If we didn't get to your question, we're sorry. I will try, we're capturing all the questions that came in and we'll try and get some answers to you. Or better yet, here's my email address. Email your question directly to me so I know who to give the answer back to. So that would be the better way to do it. So take advantage of that email that's listed right there, my phone number, and we'll see if we can get you an answer. As I mentioned at the beginning, we did record this webinar and we will post it on our website. If you registered and I have your email address, I'll let everybody know when it's posted, and then you can share that with others too, if you think it was helpful and others may benefit from it. So you'll have that. Our seminar schedule for 2023 is every other month. So January, March, May, July, and September is when we'll do our seminars. Many of you received the list in the mail that I sent out in December, so you're familiar with it, but you can also look at what the topics are at torranceMemorial.org/classes, and that'll bring you to the main site. Click on Financial Health Seminars, and you can see what the other topics are. I'm hoping we can be in person. I don't know if it's going to happen in March. If it is, it'll be on Saturday morning. So watch your email for the announcement on that. The topic in March is professional fiduciaries. Are they, what are they, and why would you need one? And we have professional fiduciary Jean Brown and attorney Grace St. Clair, who will be presenting that. March 11 is the date. That's a Saturday morning. Watch your email. I'm not sure if we do Zoom, it would be Saturday morning or on Friday again at noon, but that will be sent out. And then May 13 also is a Saturday date. Hopefully by then we will be in person on Saturday morning, and that's the topic is estate planning. And so we'll talk about putting together your will, your trust, and all the things you need as you put that plan together. So that concludes our session for today. Thank you so much for joining us, and have a great weekend.